Well, welcome back and Happy New Year. It's first month of the year. So I guess the intention is we sent out the results last Friday along with MD&A. So what we'll do is I'm sure you guys had a chance to digest it over the past couple of days already, and I'm sure there are a few questions that you'd like to ask. So what I'll try to do for this session is rather than going through kind of the detailed readout on 2019, I trust that you've already well familiar. What we'll do is we'll start a little bit with our outlook for 2020, and then we'll just touch on the highlights for 2019, and then we'll open the floor for questions that you might have for some of the numbers in the previous year, as well as outlook for this coming year. Okay, so the first one, as you can see, I think the backdrop of the macroeconomic is for this year. I think we'll see a relatively yet another slow year, unfortunately, for the macroeconomy. We see a slow growth environment. It might, our EIC, this is in our house view, is that it might be a little bit better than 2019, but frankly, a lot of the numbers that we're also seeing is kind of wildly fluctuating around below 3%. So all in all, below 3% looks to be the norm. It will be relatively slow compared to several years past. Also, the market is going to be relatively volatile. A lot of uncertainties in and around, kind of global geopolitical. The U.S. is having election this year, unknown results and the implications of that. So with that, I think we'll see a relatively kind of subdued macroeconomic situation. In terms of other numbers, export, we've projected to be flat, which is probably, unfortunately, flat is meaning better than this past year, which is that just goes to show how sort of the slow economy might be. The RP rate probably also flat for many reasons. We don't see a change from 1.25%. The Thai baht is probably fluctuating around 30 plus minus depending on the situation, but I think that's unfortunately it's going to be the new normal, which of course would affect the export, which we very much depend on. Therefore, the loan growth for the entire sector, at least our house view, is that it's going to be on a very low single digit, might be flat. Things that might shift, this particular one might be around the major, kind of infrastructure build out, EEC, or there might be major transactions that many of you, of course, are following closely. So that might dictate kind of quantum of the loan. But otherwise, generally, I think it's going to be a relatively slow year for 2020. Now, in terms of our guidance, you've seen this. We published this morning. I realize that this is probably much anticipated set of numbers that you would like to see and hear our view on what we think it might be. In terms of loan growth, I think we are projecting kind of 3 to 5%, and that is a pickup from previous year. That UICC minus 1.3%, and we can get that a little bit deeper during the Q&A. But the previous year is also a part of when we adjust the portfolio, right? We're trying to optimize for better risk return. Some of them we actually have to sort of fight for quality to do that. But this coming year or this year, we are seeing something that we'll get deeper into the portfolio mix. But we do see we continue the strategy in terms of growing, optimize for risk return. So you will see things such as, you might see some growth in corporate segment. That's simply because we feel that there are major projects and major M&A transactions that might happen, right? So if that happens, then I think that you'll see quite a bit of growth. You see EEC. And of course, unsecured lending is something that we continue to build. Digital lending is something that we continue to build. So you see that actually being the driver for our 3 to 5% projection. The NIM itself is actually interesting because this year is undergoing a couple of changes for us and structural, right? For us is this past quarter, and this will be the first full year of the consolidation of SCB Life, which of course had the impact on the NII. That also led to that also led to part of the Q4 numbers that you saw. The NII might actually look a little bit different because SCB Life no longer consolidated, and that has some implication. So this will be first year when we actually fully report results without SCB Life. So that's one. The other structural thing is the IFRS 9, TFRS 9, where you would recognize the income differently, including from the NII, right? So we see a shift, and we're trying to project the best we can. Given the shift in the portfolio, you actually see a shift in NIM from us. Apart from those two factors, one would be if we grow the certain portfolio, we might have a relatively thin margin, but a very safe asset. But at the same time, we also would grow, for instance, unsecured lending, which actually has a relatively wider NIM, but of course come with it is a different risk profile. So you see two forces being pulled together. But the important thing is that we try to optimize the risk return so that it's suitable. And so we kind of see a situation where flat NIM. We're trying to maintain the NIM, which is actually on a given the market condition of 3.2 to 3.4, and last year we closed at 3.34, that to be a NIM that's actually, I think, is quite robust for a situation that we're seeing right now. Non-NII growth, this is actually also yet another one that's structurally more specific to our bank, where some of the NII that got recognized from SCB Life would then got recognized as non-NII. The commission fee that used to be sort of removed from after consolidation will be recognized in full, along with some of the amortization and a lot of things that we discussed last quarter on SCB Life transaction. Also, we see significant growth that we want to build from wealth management as well as insurance, in addition to what we have been able to do in the past. And you would actually see wealth business as one of the kind of driver and for growth over the past 2019. As well, we continue to see significant acceleration on this one, which would lead to non-NII growth of kind of 7 to 10%, which is something that I think is positive development for the economic situation that we are in right now. Cost to income, we are actually guiding in the high 40%. A couple of clarification on this one is that, of course, when the income, we're trying to grow the income, but it's going to be in an environment where it's relatively slow. You see, we try to drive the growth from the income, but the important thing is that the cost of 2019 probably is relatively high, and we think that we already peaked on the cost in 2019. So you should see a declining trend for the OPEX on 2020, which would lead to C2I. Unfortunately, it's a relatively large quantum, so C2I will remain sticky for a little while on 2020. But we do see the positive development that the OPEX should actually start to come down visibly in this year. So on the NPL, if you see, we see the NPL, the growth of 3.4%, which is pretty much the same as last year, and this one actually came from the fact that we see portfolio over the past quarter, the last quarter, you would actually see the portfolio deterioration in some areas, and we'll get into that when you have questions. But we actually see a stable NPL on this one. Credit cost, which is actually something that's actually quite important, is 120 to 130 basis point. Net full year last year with the additional provision, additional buffer that we built in. We closed the year at 170 basis points, so you would actually see a market decline on the provision to 120 to 130. So in a way, you would see that that's because, and that actually led to quite a bit of questions from many of you in terms of what happened to Q4, the numbers, right? So the condition there is that we look at the situation and we try to take the proactive view on if we rewind a little bit, you would actually see at the end of Q3, we took a significant one-time additional provision of 9.1 billion. And at the time, we guided saying that the proceed that we have from the transaction, there was still some excess amount. And the questions were, at the time, what happened next? we guided at the time that we want to take a look at Q4 and to see the situation, whether the market condition as well as the portfolio condition, what it would look like, and then we would take decision on what to do in Q4. So as we completed Q4, we definitely saw, a little bit of slowdown in 2020 and the outlook. So that's why we decided to be prudent and add an additional buffer to cushion us and actually get us into 2020 with a relatively strong position. So with that significant build-up of the buffer that we have, we feel that this year, given the portfolio focus, given the growth that we are seeing, we should need only around 120 to 130, which is kind of renormalizing back to the levels that we've seen before this surge in the provision last year. In terms of coverage, we still intend to maintain coverage ratio of above 130%. But this is also something that's actually interesting in the context of TFRS 9, whether the coverage is still a metric that makes a lot of sense or not, because as you know very well, the way the provision will be set and will be used. But for the time being, we'll continue to report this, and we'll continue to see the coverage of above 130%. And a link to this one, I think there were quite a bit of questions coming in, considering that we set quite a bit of provision last year. The coverage ratio hasn't gone up, and in parts because the series that we did was we took a fair amount of qualitative loan classification, some from SM to NPL and some from performing to SM. That's just to take a more conservative view on that one. And based on that classification, it has certain implied amount of provision that required. So we put in, therefore, the right amount and appropriate amount in there, which would still have the coverage at the 134% that we saw last year. So the logic was the condition of the overall market is not necessarily, still in a fairly challenging outlook. So we say we classify more conservatively and trying to clean up part of that. And then we set provision accordingly. So that's why when both the numerator and denominator goes up, then it leads to, even though we put in provision, the coverage hasn't gone up as sort of proportionately. So that's sort of 2020 outlook. Basically, we see a relatively slow and still volatile year. A lot of things will continue to, we have to be sort of very adaptive to the market condition. But we believe that the way we've been actually building up our position, as well as the infrastructure that we built in the growth area, we should be able to see growth, healthy growth from certain segment of the loan business. The high margin continues. Certain from corporate should be continued to come in. We probably don't grow as much in the SME. We don't grow as much in the mortgage and the high purchase, right? The fee income will come from wealth management, will come from insurance, will come partly from the kind of loan-related fee linked to lending. In terms of OPEX, as mentioned, we believe that we've actually now peaked and should be actually on a downward trend for this coming year, right? And asset quality, as I mentioned, just completed now, we see a relatively robust 120 to 130 basis point guidance on the provision. Okay, so that's 2020. On the let me I guess. So the numbers, of course, adjusted for the one-off transaction in life insurance, you would actually see a slightly different number. We don't see this 59.3% or things like that, but we do see growth in the top line. We see growth in the non-NAI as well across the board. So that's actually a good sign. The loan growth, as I mentioned, the loan growth looks a little bit of a decline, but actually that was towards the end of the year when we tried to optimize the risk return, as I mentioned. So you would see actually quite a bit of corporate loan portfolio reduction. That's part of the attempt. The NIM, you saw that. There's some of the highlights are as shown. If you break it down, you would actually see the one that actually continue to grow the top line. The expense, we actually, there's quite a bit of, obviously, from the number-wise, you would actually see an expense jump from people costs and as well as from the depreciation from the investment that we've made over the past few years, right? Buffer that we put in for the provision, so that's that. The net profit around 1% growth. In terms of non-AI and AI composition, what we actually have to notice is fourth quarter, of course, the deconsolidation of SCB Life led to a decline in average NII that we would see. But at the same time, we also have the lower quantum of the loan. So in and of itself would actually drive the NII down a little bit. But the real reduction is actually coming from deconsolidation. Loan growth tracking economy. In terms of fixed deposit and CASA, it looks kind of relatively stable compared to previous year, and we continue to build up the CASA position, which actually proven to be, of course, difficult, but it's also important part of the low-cost deposit strategy that we try to drive. NIM, I think for people in this room, I don't think you need to be educated, but you would see actually some people say, significant NIM drop and stuff on that one. Partly, 3.68 was inflated because of the SCB Life. At the time when we deconsolidated, the numerator and denominator didn't work out at the same time. But, if you see the blend, if you see the average, you would actually see a general improvement in terms of NIM per the strategy that we mentioned that we want to expand towards more overall risk return, more effective, and not just from NIM expansion, but from at the end of bottom line, including credit cost and everything. In terms of loan, as I mentioned, you would actually see corporate loan decline by quite a bit, but that was actually intentional. We're trying to kind of lean the portfolio, rebalance it if you don't get the right kind of return. Both the NAI and non-NAI linked to that particular loan, we try to kind of consolidate and try to rationalize the portfolio. So you would see that. And frankly, I think people in this room are quite familiar. Corporate loan growth in and of itself, it's fairly bulky, and you can actually drive it up and down quite significantly and wildly. So the real thing is how do we try to rationalize it. And SME is relatively flat. Retail, as I mentioned, for secured lending, we try to optimize. We try to shift the portfolio mix within to improve the better risk and return. And unsecured continue to grow. On the yield, I think some of you might have some questions that there seems to be NIM yield compression or decline in the fourth quarter. What you would see there are a couple of things that drove that, right? One is from the fact that, as I mentioned, flight for quality that we try to optimize. And towards the end of, I guess, last year, you would hear a lot of measures that being put out by various, I guess, including the regulators and including some internally as well, to reflect tightening of the underwriting to make sure that we really screen for cream in terms of risk return. So if you go for a safer segment within a particular product, then the NIM, the yield will naturally compress. And that's actually seen in some of these retail products, right? Some of them, the decline came from the MRR rate cut. So that's actually typical enough. And other thing is also coming from essentially we're trying to optimize the portfolio towards safer assets. So that's why it explained the yield compression. But at the same time, we don't have it on this page, but the NIM, as I mentioned, on the overall aggregate, we continue to see NIM expansion, which is kind of small it might be, but it's actually expanding. Now on the NPLs, that's also, it looks, I would say, if you look at it and you kind of take a little bit of a step back, you would see every now and then you might see a little bit of bump or dip, but all in all, across all major segments, it looks to be relatively kind of renormalizing to what it has been in the past, except SME, where you see a jump, right? I mean, that's huge jump. But as I mentioned, it was due to qualitative classification of a lot of SME account. Quite a lot of the new NPL formation that you saw you saw 18 billion of new NPL formation in Q4. And well, of course, in third quarter, there's one big corporate client that we all know. And Q4 is this one. If you take out some qualitative, you actually would revert back to more or less Q1 and Q2 kind of number. So in that sense, that's why we're saying that when we kind of put in numbers for the numerator, denominator for the provision, when you put in the same amount, the coverage didn't go up, but because we already try to be conservative and be more prudent when we try to do this, right? But suffice to say, well, not suffice, but it's important to say that some of these names, we apply a fairly strict standard, well beyond. In fact, we're not yet leveraging the sort of more relaxed classification of SME. If anything, we try to be more stringent and strict because this is where things could be quite volatile. And the event that happens, we are, at least some of them we already account for, which leads to a spike in the SME new NPL. The coverage, naturally, we built out the credit cost over time. Our it doesn't show here, but the amount of reserve is 114 billion or something like that. And when you divide it by the NPL, you get the coverage of 134. It might look like a drop in the coverage, but if you factor in large corporate account, which we provision sufficient amount of provision net of collateral, which by definition is less than 100% coverage because there's a collateral, as well as some of the the classification, the conservative classification, the provision. So that's why it dropped. But otherwise, this would look to be fairly high in terms of coverage, not 134. The recurring income and of course, there's no net insurance premium anymore in Q4, and you can actually, you've seen this. I will not try to bore you with the reading off the chart. We took a slightly different cut just to reflect the fact that we're focusing on, kind of make it more aligned with what we mentioned as a strategy for you, wealth management, bank insurance. We got the feedback. We've heard that. We changed that. It may complicated for some of you. Apologize for that. But so going forward, we'll try to kind of keep it in this format where we expect to see growth from wealth and bank insurance in a meaningful way. And Q4, you start to see that. And hopefully we'll be able to show you much more traction when we announce Q1. In a few months' time. Of course, we just started the year, but we are hopeful. Transaction banking, I think we all know this one is only going to decline over time just from the nature of the business. But the real proposition of transaction banking is that of number of customers as well as CASA base as opposed to fee income. Operating expense, except for the kind of dip because of the one-time gain recognition, we saw a spike in the OPEX, which is something that I think led to a few questions that some of you might have. But otherwise, the cost to income looks to be in a 49% range. Came partly from the, kind of the employee expense as well as depreciation. This one is interesting because we don't have time to go into some of the numbers in the appendix on the strategy part, but I do recommend you to see it. We try to update you with the latest sort of headline numbers, such as number of customers, the nature of transactions. You would actually see that a lot of transactions now happening on digital channel, right? You would see, for instance, the banking agent network that we built started to take or offload the service-related transactions in the branch already. And you actually already see, the transaction that happened in the branch, 3% out of 213 is already quite low, a lot lower than 15% of 69. There were a lot of questions back then, and this trend only started to see, for instance, if you do 109 multiplied by 9% or 143 multiplied by 6%, you kind of see, percentage-wise, branch tend to have decline, but absolute-wise, it hasn't. But if you see it December 19, you would actually see that it indeed has declined. So that goes to show that the activities in the branches started to come down, which would allow us to be able to really rationalize the infrastructure cost, right? Unfortunately, right now we're still living in a sort of two infrastructure. One is digital, and the other one is physical. What we need to do is continue to actively migrate people from physical into digital, which would allow us then to rationalize the network that we have, both in terms of number of branches and any physical touch points, right? That I see, unfortunately, relatively heavy in terms of cost. And linked to that, of course, is the number of people that we have in the organization. So if we go back to the previous page, you would then see that that's why we would. It's something that we are actively working on to try to basically migrate and rationalize on that one, which would actually drive down the total OPEX for this coming year. Capital, you are aware, and yes, is high. And the rest is sort of the business plan, the numbers. For sake of time, I will not go through that. I'll just, but it is important that if you do have time, please flip through some of them because they point to number of customers. For instance, we now expand to 16.4 million customers. The jump actually came in the past few years, which speaks to the fact of the engagement effort that we've done. Number of customers on Easy is 10.5, and the channels that we talked about. So that's sort of highlights of the previous year as well as the guidance for this year. There was some you will see us one statement that we say we removed the dividend cap of 50%, right? So it used to be we guide the dividend policy is 30 to 50%, but now we say above 30%. It's actually meant to be a positive thing. But many people, it's like, are you now not going to pay as much as it's meant to be positive? We try to keep it flexible, especially in the kind of high capital regime. We want and lower growth and things like that. We want to make sure it's flexible. It's meant to be positive. So please help reflect accordingly. The other one that also came in from various sources is the announcement that Kunatit made on the 20 billion investment in the technologies, right? So this one needs some clarification, and I think he mentioned it to press and media. It was it needs more clarification. In fact, we'll do a more formal announcement this Thursday. This 20 billion is different than the 40 billion transformation program. So if you're asking yourself how to incorporate 20 billion, it's not CapEx, it's not OPEX, but it's an investment, right? So it's a financial investment mostly, but linked to, and I'll tell you a little bit about SCB 10X, which is something that you probably picked up in the news feed already. But the essence is that as we see the slowdown in the overall banking sector, not just us, not just Thailand, it's just regionally and globally. We see that we need to rethink about how do we create new growth above and beyond what we already discussed, wealth and insurance and digital lending, which would be the primary growth for the main bank. At the same time, since we came into the proceed of 80 billion of excess cash from SCB Life transaction, one of the things that you probably have in mind, and many people is asking, how do we plan to monetize that, right? In the short term, we, as mentioned last time, while we help with the liquidity in terms of replacing the high cost deposit, we do a lot of things. But fundamentally, to create growth, you need to actually redeploy it effectively. It will be a couple of options. One is to do, kind of get into the new business, be it M&A or significant investment, and also drive growth from the high growth businesses, technology-driven businesses and business models. So SCB 10X, in the essence, what it's trying to do is that we built on what we've learned over the past few years. I would kind of, the headline would to say go from experiments to exponential. Meaning, for instance, we have digital ventures, we have venture capital fund, we've set up a few subsidiaries over the past few years. Now, SCB 10X is consolidating all these things into one entity, a separate legal entity, trying to focus on building tech-related growth, which will, significant amount of 20 billion already, or not significant, sizable amount already coming from the existing portfolio. Publicly known 150 million US venture cap and a few direct investments, totaling up 30-40% of the existing portfolio already kind of been in the works over the past few years. So now the idea is how do we leverage? So 20 billion, in a way, 20 billion out of the 80 billion proceed will be used on the technology-related businesses, which actually come in three parts. One is, the one that we kind of familiar with is the investment. These are some of the example of the names that we've invested in, either fund of fund or direct investment. You know them well. For instance, Ripple, that you've heard that they're actually doing well as far as global remittance company, blockchain based, and then we've been fortunate enough to get in the investment early, and that should actually be a pretty good investment, as you'll find out over time. Some other investment. So if the idea is that if there are good opportunities, if we can support, we can participate, we participate, which actually links to not only financial return, but also the new capabilities. For the Ripple itself, again, as an example, this is a couple of years back, we actually helped them grow the business through cross-border remittance between Japan and Thailand, as well as Thailand and regional within CLMV. So that one, not only we invest in the parent company, but we also help them grow. So that's supposed to be the logic of the investment, not just putting in the money in various pockets, but it's where we can actually add value. And that's actually one example, right? A few other, there's some information of this in the website. But if there are no such companies, what do? We build. If we believe that we find a business that could create exponential growth, we're not looking for something that would expand kind of BAU plus type of business. We don't do, main bank should be doing that. Main bank should continue to say, how do we make digital offerings of certain products and services? But this thing is supposed to be leaps and bounds in terms of the complexity and in terms of the ability to create new growth, right? Digital ventures that you saw the news of Kun Orapong, who used to be our president. He stepped down from the president and joined DV as CEO of DV full-time to create the new growth from DV. So he's very much part of the family, but he's now, kind of taking charge of how do we drive new growth from that one. SCB Abacus, you're aware of digital analytics as well as digital lending company. So if we believe that there's gap within the country, within the region, if we can do, we try to build. But important thing here is that it's not requiring huge amount of investment. By definition, exponential type of platform, you need to be able to leverage the capital market. You need to invest a small amount to prove the concept, and then soon after that, you need to leverage the venture capital platform to grow. Because some of these things, if you say we have to fund everything, it will not be effective, as you know quite well in terms of how startup would be requiring the funding. Right, and some other things that if we work with partners, if there's some interesting companies that are relatively mature, either we partner with them to build new offering. Nix, this is another partner that we met through one of the funds that we invested in China. They introduced us to this company to set up, basically remove the digital platform that they have in China, relatively successful, to Thailand. Or some we might do significant co-investment. So the idea is then, part of the proceeds from the SCB Life transaction, 20 billion, we try to redeploy them in a high growth area, but we do so in a way that's sort of step by step, what they would call a stage gate approach, where we don't just throw in big money after some opportunities, but we systematically go through, which is a pretty rigorous process of making sure risk return is right. It's higher risk, but at the same time, of course, on a blended return, this could actually turn out to be, not turn out to be, but we expect this to be one of the growth drivers for the bank. It might not happen over the next 1-2 years simply because of the nature. For instance, Ripple, when we found them, they were relatively small, and they're incurring losses along the way, but now they're starting to turn. So it requires a different type of P&L profile that we might be used to, but these are something that will over time we continue to engage with you on in terms of what it might mean, right? But until then, that's the plan on that one.